Ed Stacey from Capital Networks with me in the studio today. Ed, good morning.
Hi there.
Just a reminder for Ed's full report, click on the eye in the top right-hand corner of your screen. Ed, Plastics Capital, full year results out today for the year to the end of March. A pretty strong year for some parts of the business here.
Yeah, so you have revenues and earnings per share both slightly ahead of our forecast, 77 million of revenues, 9.5 pence of earnings. No big surprises there. They had the trading update, detailed trading update out in May, so no surprises. It's in line with what they'd said back then. But it is an interesting statement as you look down at the details, because remember, this is the first full year of the new growth program. So they had this new strategy to try and promote top line growth. And when you look at the numbers, the organic revenue growth, i.e. excluding acquisitions and FX, organic revenue is 13% up. So that growth is coming through as planned. It's come through most strongly from the films business, the plastic films, that's for industrial and food purposes. Also the hose mandrels, so that's to do with hydraulic hoses. And both of those, it's market share gain. It's not that the markets have been growing that strongly, it's they're winning new customers. So the growth plan is working.
The profit margin, that was lower than the previous year, but of course that was forecast. Just give us a quick reminder about what was behind that.
Yeah, so mix really is the main driver there. So as I said, the films business was growing strongly. That's actually one of the lower margin businesses. The one business that really didn't grow so well in the year was plastic ball bearings. So that goes into things like your car steering column, household appliances, things like that. That's a very strong margin business, didn't grow as much, so that mix effect has worked against them. But the important detail in the earnings release is they're saying that has started already to improve now the industrials division as a whole. And I think what the message is that going forward now, we can start to see those margins increasing. That will be both from the mix starting to come more from all of the businesses and also from just volume effect within each of the businesses. So I think we're set now for margins to start to improve, and that's what you probably should expect with this type of growth program. It's the revenue growth that comes through first, and then you'll start to get the margins pick up and the earnings growth come through.
So set for increasing margins here. So just a final word, Ed, the investment proposition here in your view?
Yeah, well, I think, we've been following Plastics Capital pretty closely for a while now, as you know. And I think it's a very exciting time for the business with this growth program now starting to deliver results. From an investor's point of view, the really interesting thing is it's still only on a 9.5 times PE. And I think if this growth starts to come through in earnings per share growth, then in 1 year, 2 years' time, you'll look back and wonder how were the shares ever on this kind of cheap valuation. So I think value and then segueing into growth, that's the messages for investors.
That's great, Ed. Thanks very much. A reminder for Ed's full report, click on the eye in the top right-hand corner of your screen.